Hello everyone, I'm Nova Loy, the Head of Investor Advisory at RHB Bank. Welcome to our Money Chat. Today we are fortunate to have three esteemed speakers discussing the factors behind the fluctuation in the global equity market. Our first speaker is Stephen Choo, Senior Portfolio Manager and Analyst at Voya Investment Management, who will offer insights into the dynamic technology sector. Following Stephen, we will hear from Raymond Jing, a portfolio manager at China AMC, joining us from China. And finally, Mr. Choo Swee Kee, the Chief Investment Officer of TA Investment Management, will address concerns and explore any potential news that could impact the Malaysian equity market. Stephen Choo from Allianz Global Investor is joining us today all the way from San Francisco. Thank you for joining our show today, Stephen. Let's kickstart our Money Chat today with the global financial landscape and how it shapes the global equity market, especially when it comes to technology sector, which is relatively sensitive to the rate cycle. With the interest rate staying higher for longer and the increase in the geopolitical risk market, should investors expect more volatility in the growth or technology sector? Do you think the equity market has priced in most of the negative news?
Yeah, it's been a very interesting year. We've had a very strong first half of the year through July where the markets performed well. You had growth sectors rebound a lot after last year's sell-off, but it was really driven by good fundamentals. You had strong earnings. The risk of recession was pushed out. And so you saw the equity markets really recover through July. As we got into the summer months, we did get volatility higher. Both on the higher for longer interest rate environment, as well as more recently the Israel-Hamas attacks. And so, you saw about a 10% pullback in the market through October. You saw a little bit of a rebound more recently. But, I do think that the market over the last couple of months has been much more defensive. You've seen the larger cap names, particularly the Magnificent Seven, the large cap, mega cap, tech-related names, really outperform, as those are kind of viewed as the more defensive, durable business models. When you look at the broader markets, though, the S&P is only up 11%, but most of our gains are driven by the Magnificent Seven. So the S&P is actually flat through the end of October. And if you look across sectors, it's really been driven by the mega cap tech names and communication services names. The Facebook, Amazon, Google's, have really driven the performance. NVIDIA's have driven the performance. When you look at the other parts of the S&P, they've all been down. You've got materials, financials, staples, healthcare, real estate, utilities. So it's been a very narrow market because of the uncertainties. I will say that, last week we saw the markets begin to stabilize as, the Federal Reserve, is pretty much, I think, almost through the rate hike cycle. I think they're likely to pause from here. We saw the CPI numbers this morning come in much lower than expected. And so you saw the market rally in the hopes that, the Fed is done with this tightening cycle. I still think we'll see a little bit higher for longer, but I do think the bulk of the interest rate sensitivity has been priced in. And so, from here, we still have a little bit of macro volatility with the geopolitical landscapes. Here in San Francisco is the APEC conference. President Xi and President Biden are supposed to meet the next day or so. I think there's more positive tone around those meetings. So we're hopeful that the volatility can start to subside some, but I still think there is still concerns about slower economic growth as the lag effect from the 500 basis points of interest rates still adds a little bit of volatility. But I do think the big bulk of the volatility was in September, October, and we priced in the higher rate environment now. Earnings have been much more resilient. We're pretty much through Q3 earnings season, and the average beat has been pretty good. But we have seen more volatility between the companies that can execute during these tougher environments and those that cannot.
Given the strong year-to-date performance of Nasdaq market as a proxy for the technology sector, does it mean that the market has run ahead of its fundamental, leaving very limited potential upside for investors who wants to join into the bandwagon now?
I wouldn't say, as I talked about earlier, the market breadth has been very narrow. So among the large cap, mega cap tech names, I do think Those have priced in a lot. But as you look underneath that, small cap stocks have underperformed. They're negative year to date. A lot of other sectors are negative. So I think, what we saw today was the market breadth start to broaden out. You saw the Russell 2000 growth up over 5%, while the broader markets were up a few percent. So I do think there was an opportunity to a lot of these other companies that are down a lot year to date to play catch up. And so maybe the mega cap names that have led the market begin to kind of level off a bit, while the rest of the other sectors and other parts down in market cap in particular, they've already priced in a mini recession, priced in a lot of bad news. And I do think if the rate hike cycle is done, economic growth while slowing is still positive, that we can see the market broaden out and small mid cap stocks start to play catch up. That the mega cap names, maybe start to underperform on a relative basis. When you look at valuations across the sectors, most sectors are kind of below where they were in 2019. So you go back to the pre-COVID levels, the S&P is around 19 times versus 21 times pre-COVID. Technology is slightly above where it was in 2019, but that's mostly mega cap driven. So information technology is around 28 times earnings. If you strip out the large mega cap, it's probably more like 25 times, so more in line where it was. And a lot of the other sectors are below 2019 levels. So they've already, I think, priced in this higher interest rate environment, risk of recession. And so, I do think the earnings resiliency has been good. I think companies continue to leverage things like generative AI and productivity and automation to drive efficiency gains. And I do think that can hopefully make earnings more resilient despite, slightly more sluggish economic growth.
Given the latest news indicate that NVIDIA has discovered a method to sell AI chips to China, how impactful do you perceive this advancement to be? Could this potentially prompt increased scrutiny from the US government towards chip manufacturers? Alternatively, might it mark the initial stage of a more lenient approach to supplying advanced technology chips to China?
I think we've been kind of going through these escalating geopolitical tensions over the last couple of years. If you actually rewind the clock to earlier this year, the U.S. did put additional restrictions on NVIDIA. And so they created some additional new chips that were less powerful to sell to China. And they were doing those in the first half of the year. More recently, the U.S. government came out with some additional restrictions to lower the compute power. And so NVIDIA kind of retooled it again to lower the performance of these new chips to sell to China. So we've been kind of on this ongoing evolution of advanced technologies and trying to protect the U.S. And so I do think NVIDIA has been quick to adapt to the new regulations. And so they're finding ways to work around some of these additional restrictions. China continues to invest aggressively in its own semiconductor industry. They're still several years behind, particularly for the cutting edge chips, but they're making progress. And so, I think we're hopeful that the upcoming APEC meetings in the next few days will have, I think, lead to more leniency. I think the U.S. has put the bulk of the restrictions out on there already, and so I think everyone's learning how to work around this new higher regulatory environment.
Thank you again for joining us today, Stephen. In the Q4 2023, investing into technology, especially in AI-related themes, is among our key investment themes. Dear investors, do engage our relationship managers to get more insight on how you can participate in the growth of artificial intelligence. Thank you again, Stephen.
Thank you.
Okay, let's move to the elephant in the room. Again, China. Chinese equity market extended its downward trajectory for 3 consecutive years. This year itself, all 3 Chinese indices, including HSCI, HSI, and FTSE China A50, are still down. In Malaysia's unit trust industry, we have witnessed close to net ringgit 1 billion inflow in such equity funds. However, investors are now nervous, and we have seen some sign of outflow from the third quarter of 2023. Raymond, given the high expectation on China's equity market post-China reopening October last year, however, the Chinese equity market lost its momentum from the second quarter this year onwards. what has caused the reversal from the China reopening story?
Okay, after the reopening scenario happens in last Q4, and the Chinese market actually experienced like 1 quarters of rebound. But after that, the performance coming a little bit weak. I think the main reasons mainly comes from below reasons. Okay, the first one is that we saw that the relationship between China and the US, we didn't see too much improvement. So that will have already led the outflow from the foreign investors from China market. And also we saw that the America, the US, they level a lot of sanctions on the China's cutting edge high, tech areas and companies. So such kind of behaviors will hurt the risk appetite of the investors in China. And the second reason mainly comes from the US, Fed interest rate hike, because in the first 3 quarters this year, originally actually at the beginning of this year, we all anticipated that the interest rates, hike cycle will end quite soon. But actually the reality or the fact is that till now, we still haven't seen the signs that the US Fed began to cut its interest rate. But actually, we have already seen that the 10-year Treasury bond interest rate of US becoming, coming down, okay, from its highest level, like about 5 to like below 4.5. So that is a very good sign for us to say that the interest rate high cycle seems coming to an end finally, okay. And the third reasons for the poor performance mainly comes from that the investment and the sales of China in the property market, real estate markets, continuously below the expectation of the market. And it seems that the government's policies towards the real estate market and such kind of supporting measures is below the expectations by the investors, and that will let the investment for the real estate markets down by like 10%. That has a major difference between the expectations at the beginning of this year and now. So that is the we saw all these non-ISOE developers, they face some challenges and they face some difficulties to repay their interest and debt. So that has very clearly exposure to the risk. Okay. And the fourth reason, I think that after the reopen scenario, we did a lot of studies in different regions. For example, the Asian countries like the Japan, Korea. We find that usually after reopen, it will take like half a year or 3 quarters for the citizens get back to their normal behaviors of the consumption. So that we call the scar effect after the reopen. Okay, that also happened in China, because if you see that in the first quarter and the first half, the spending by the citizens is still quite prudent. Okay, compare with the for example before the COVID behavior or trend. But since Q3, it seems that the consumptions in China began to warming up. Okay, it means that China have already passed such kind of a period of scar period after the reopen. And the fifth reason is that some industries or sectors in China, they face quite severe supervisions and anti-corruption, such as healthcare. And also the financial sectors in China, we also saw a lot of the anti-corruption behaviors or activities conducted by the Chinese government. So such kind of the supervisions and corruptions also have negative impact on the risk appetite in China market. So I think the last 5 reasons contribute to the main, I would say performance, why the performance Chinese equity market in last 3 quarters below the expectations of the investors, both for the domestic investor as well as foreign investors. Yeah, Noah.
So Raymond, a few Chinese property developers, including Evergrande, Country Garden, and Wangke, are facing challenges in meeting their bond coupon payments. Socially, there are also worries whether this ongoing property project will ever reach completion. Simultaneously, investors are concerned about potential repercussions on the banking sector. My question is, if a collapse were to occur within the Chinese property sector, what are the implications that might arise, and how would the fund manager like yourself position to prevent such catastrophic scenario?
So property market, real estate market actually in China is very crucial. It's very important, right? The new sales of China's real estate hit like 1.8 billion square meters. But if you look at the most recent number for the new sales of real estate in China this year, should down by like nearly 10%, 10, right? 1 billion square meters to 0.7 or 0.8 billion square meters. So that means that in last 2 or 3 years that the market have already been a very, very difficult period, and it's quite tough. But from very low base now, we didn't see any, further decrease or drop from such low level, because if we look at the years before, like 2015, 2016, the mid level of the new real estate market sales in China should be like 1 billion square meters in China per year. So now actually the level is obviously below such kind of mid-level. So we need to believe such kind of the supporting policies by the Chinese government. The first one is taking over this non-SOE companies and inject money to them through the, no matter from the banks or the commercial banks or the policy banks of China that will support such kind of completion of the projects unfinished for these developers. And then China also exploring new types or new patterns of the real estate market. We said it's quite like the Singapore style, right? Most of the citizens their need to buy a house should be by the government, such kind of the schemes for them to buy this very affordable process. But for the other side is a premium household. Okay, it also contribute another like 20% to 30% of the market in the next few years. So that by such kind of the transition from the old type to the new type, we will see. Yeah, we will see that the new investment in real estate market will stabilize and also can reach like the mid level of last few years. But the main players in the market should change from before 3 to 4 years. The main players in real estate market in China with those the non-SOE companies like Evergrande, Sunac, and Country Garden. But from now on, in next few years, the main players in the real estate market in China should be SOE companies like Vanke, like China Resources, like Zhonghai, or there's Merchant Shekou, there's SOE big companies, Poly Development, etc. So for the interest rate repay or debt repay difficulties for those non-SOE companies, we think the hardest time has already passed. So we didn't see too much unprecedented raises happen. Should comes from those non-SOE developers, and we are pretty sure that the quite robust the financial systems in China in terms of the banking as well as the central government's abilities to help is quite strong. So we don't think such kind of the risks will lead to much more, unprecedented risks happen in China economy as well as the financial market. So I think the hardest time have already passed. Okay, we needn't to worry more on the real estate markets to cause more, unprecedented risks for the Chinese market. So that is my opinion, my views on that.
Dear investors, if you have any question for Raymond, especially relating to the Chinese equity market, do put down in our comment box below. Investment is long-term, but investment holding is not. I trust that a good fund manager, especially like China AMC, which is locally based in China, will have a better insight to navigate itself within the volatile equity market to deliver better return for investors. Okay, Swee Kee, going back to Malaysia, our domestic market, so there is very little catalyst for the upside potential in Malaysia. FBM KLCI is down this year and also among the weaker performer in the ASEAN region. Malaysia also losing out in terms of FDI among other ASEAN countries. What has caused this?
Right. Hi, Noah. Yeah, I think we are biased and we are being too negative on Malaysia. Yeah, I think what you say is true that Malaysia had gone through a bad period with ineffective government policies and it's just struggling to adjust, to the frequent political changes in the past. Yeah. But I think things have changed, right? And looking forward, I think we see hope in this new stable unity government, which has rolled out some key initiatives in the right direction. Yeah. So in terms of the we're talking about the market gain, right? I think Malaysia is somewhere in the middle. Right? In the first half, we were a bit of laggard. There were lack of clear direction. But in the second half, we have improved, right? As key policies start to roll out. So, but I think, of course, it is still work in progress, and there are still many initiatives to be done, right? So I would not say that Malaysia is actually the last, right? I think we are in the middle, and we are actually in line with our ASEAN neighbors.
Yeah, thank you for your answer. Bank Negara Malaysia maintained the overnight policy rate at 3% for the third straight meeting. However, with the rationalization of government subsidies, inflation could potentially increase. Do you think Bank Negara Malaysia may further hike interest rate despite Fed has recently paused its rate hike cycle? And what about the implication to ringgit?
Right, I think in terms of the what you call our overnight policy rate, they did not hike the recent round, and I think they also probably indicated that there will be no further hike, this year, right? So I think this is also generally in line with what the Fed has recently indicated. They also did not raise interest rate. So, and I think now, although they did not say it, but I think the market is really expecting that the US will not raise hike anymore for this year. Possibility, there could be rate hike next year, but I think that very much depends on the inflation number coming out. And I think obviously, a lot of people, you mentioned also about the ringgit weakness. Yeah, honestly, for myself, I really could not understand why it's so weak, right? It could probably be due to just lack of confidence or due to our current budget deficit. Yeah. So, and obviously, I would say, actually in Malaysia, there are three things playing along now, right? First, of course, we are talking about inflation. Secondly, we're talking about our interest rate, also meaning gap between our interest rate with the US. Yeah. So I think earlier on, our ringgit were weakening because the US were increasing interest rate quite aggressively. It even overshoot our Malaysian rate of increase. And that actually has pulled in a lot of US dollar, right? Pull in a lot of money back to the US. But I think with this recent possibly pause in the interest rate, I would think that our ringgit weakness would probably also pause. And do note that, generally Malaysia interest rate direction has always been more stable than the US, in the sense that we do not raise it, as aggressively as the US. And then talking about on the other direction, when cutting interest rate, we would also expect the US to cut interest rate more aggressively than Malaysia. So if you bring this dynamics into consideration, we are probably at a point where Malaysia is probably at the weakest against the US dollar, and actually we think that the US dollar will weaken moving forward. So I think that that's what we expect, right? So now other than that, I think talking about what I call inflation, right? As I said, this is the third element that Malaysia, have to balance, right? In the sense that, we want to control inflation, but we are also trying to reduce our subsidy. Because early on I mentioned that the lack of confidence in our ringgit is also probably due to high government subsidies, which is creating a huge current budget deficit for Malaysia. So to strengthen the ringgit, right, I think it's critical that we also reduce the subsidy. Now, if we reduce all these subsidies, there is also the concern that it will cause inflation. So that's why I said it will be a very delicate balancing act that the government has to do. So they will have to control the interest rate, they will control, how much subsidy they remove, they will control the inflation. Yeah. So we would think that there should be they should be able to balance it, and I would not expect to see runaway inflation. As we remove the subsidy, we will think that everything will be progressive, but we do not expect, in the case with the subsidy removal, that inflation will come down a lot more, right? In fact, it may actually even increase a bit, but we would think that the government will control it. So I would think that if the next 6 months our current government can do this well, our ringgit should strengthen.
Talking about the foreign investors' confidence on Malaysia, which might somewhat impacted the weakness in ringgit, appreciate if you can give us some insight on your view of Malaysia political stability. With recent few oppositions openly announcing their support to Prime Minister Anwar Ibrahim, is that show of strength of our government stability? Do you think in the near future this will encourage foreign investors' fund flow into Malaysia?
Right, on the MPs moving, I would say that I would call this jumping over the fence, right? It's actually quite a standard rumor in Malaysian politics, right? And in every government also there will be MPs jumping around, right? So I would not read too much into this. And every ruling government always attracts jumpers, right? So I think the key to stability is the number of stable or sticky seats that the ruling government has, and actually you just look at the numbers, from the beginning, that this unity government, we believe that it is more stable than the past two governments, as it has almost 2/3 majority, right? And you compare to the past two government, they almost just barely cross the 50% level only. While this government has, as I said, almost 2/3, right? So yes, I would think that this new government will be more stable and it will be viewed positively by investor. Yeah. So if they are, I think if we if we come up with the right policy and we give a direction of where we want to go, we believe that we can actually attract back some of these foreign funds into the market. Yeah.
Dear investors, it's truly a pleasure to have heard from our three distinguished speakers, each an expert in their respective field. We encourage you to connect with our relationship manager to explore strategies for rebalancing your investment portfolio, especially considering the potential end of the US Fed rate hike cycle. See you again in our next Money Chat series.